Hey everyone, Brian Lauer, One Life Financial Group. In today's video, we're going to jump into 5 critical wealth management questions to ask during an employment change. So sometimes employment changes can feel overwhelming with all of the benefits, the tax, the income adjustments. And so my hope is that today's video will give you some clarity and confidence as you make financial decisions moving forward that are designed to help you secure your future and live your very best life. So let's jump in. Question number one is, how do my financial plan's probability of success change? So either that probability of success will go up or it will go down. I rarely see it stay the same. And knowing the answer to this question could give you a lot more clarity and confidence with your decisions coming up, or just help you feel more secure in your future. If your plan's probability of success increases, that might help you make decisions about pursuing new financial goals, or maybe adjusting retirement time horizons or giving amounts, or just give you more freedom to enjoy the wealth, the money that you have. On the other hand, if your plan's probability of success decreases, first of all, you're not alone. Many people have that outcome, and sometimes it's actually desired. It's a great trade-off for maybe a better job or less stress or more time with loved ones. If your probability of success isn't where you want it to be, for a lot of the people that we work with, if their probability of success and historical stress testing is below 75%, let's say it's at 50%, that might be a great opportunity to be proactive and adjust some of the goals and assumptions in your plan to get to a point where you feel more secure in your future. So if you have an offer letter and your probability of success stays the same or it decreases, that can be a great negotiating point with your future employer if you haven't accepted an offer yet, where you could simply express your appreciation for their offer, restate the value that your experience brings to their team and how you can use that to help them succeed. But also just mention that you're not sure how you could move forward if the offer is neutral or if it's taking you back a step in your financial plan. And we've seen clients use that to sharpen up the offer and tip the odds in their favor with their compensation or benefits. Now, if you don't have a financial plan that tells you what your probability of success is with your current employer or the next employer, you're not alone. A lot of people don't have a financial plan, but now could be a great time to develop a plan to see if you're on track to achieve your goals. Okay, so that is question number one. How does your probability of success change with your new employment offer when you're faced with a job change? Now, your financial plan can also help you explore tax minimization opportunities. And that's question two. What unique tax minimization opportunities exist this year? Now, in the year of a job change, in 20 years, I have never seen somebody's income and benefits stay the same. I'm not saying that's not possible. I've just never seen it. So that typically means that income is either up, taxable income is up in the projections, or it's down. And both of those scenarios can present a very unique tax planning opportunity that might not exist for quite some time. So what do I mean by this? Well, if your income projections are up for this year compared to prior years, you could proactively explore some opportunities to lower your taxable income, which could include adjusting deferred compensation, 401k, 403b, TSP contributions. It could mean that you might want to consider, if you're doing any charitable giving, doing some creative giving where you batch contributions or start a family charitable fund, also known as a donor advised fund. That could help lower that tax burden, especially if you jump to tax bracket. On the flip side, if income is down this year because of an extended search, or maybe you lost out on some options that you typically would exercise, this could be a great time to actually move money from a taxable source like a 401k into a Roth IRA. because of the lower tax bracket. So for example, if you were in the 35% tax bracket and you jump down to the 24% bracket, that's an 11% potential decrease in federal income tax when you compare those brackets. And so those could be some great opportunities to just look at and consider. There are others as well if you're projected to be in a lower bracket in the year ahead. Additionally, this can be a great time to look at your Roth 401k or your Roth 403b projections compared to pre-tax 401k and 403b. So if you have a financial plan and you're running tax projections, this could be a great time to analyze your current strategy and see if a change. So if you're currently doing all pre-tax, you might want to consider running Roth as part of a scenario, just to see if it increases your after-tax wealth in your planning projections. So again, this can be a great time to ask that question. What unique tax minimization opportunities exist this year when you're faced with a job change? Question number 3 is, how could you optimize company retirement plans and avoid 401k headaches? So if you've left your employer, sometimes people are just eager to get their money out if they didn't leave on bad terms. But I would encourage you just to ask the question, what option is best for your 401k assets? Maybe it's leaving it where it is. Maybe it's moving it to a rollover IRA where you might be able to access thousands of investment options instead of a limited menu of choices. Maybe it's better to move it to the next employer plan. But you want to consider, what options do you have for Roth conversions? What options do you have for beneficiary designation? Some employer plans are very strict about that. They don't let you name trusts. How many investment options are there? What are the costs? What are the restrictions? So there's a laundry list of items you'd want to analyze to figure out how could you optimize the money that you worked hard for, the money that you accumulated in your 401k that could benefit you. The other part of the 401k is, what are some of the 401k headaches you can avoid? And I'll let you know one of the most common ones, sometimes it's difficult to avoid, is employers do not talk to each other. So if you were working for, let's just say Target, and you went to Walmart, or let's say that you're working for Chevy and you move to Ford, those competitors don't talk to each other. They don't share how much money you contributed to your 401k. So you're at risk of making an excess contribution if you're not managing your contributions. And that just means at tax time, you could get a letter from the IRS, or your accountant might tell you that you over contributed and you need to take money out. So it can make sense to proactively ask the question, how could you avoid that excess contribution headache? Now, sometimes the second employer offers a larger match than the first employer. And in that case, you might want to explore over contributing on purpose and going back to your initial employer and seeing if they'll refund your contributions, because you could get a bigger potential match. Now, your initial employer might not do that, so you would just have to be proactive, make a couple calls, or make some calls with your financial advisor to determine what might be in your best interest. So that's question 3 to ask. In the year of a transition, how could you optimize your company retirement plan benefits and avoid potential 401k headaches? Question number 4. What's your stock award strategy with your old and new employer stock award plans? If you do not have a stock award plan or a stock strategy, you could just skip to the next question. If you do, your stock award strategy can impact your tax projections. It can also impact your investment strategy. And if you don't have a strategy, but you have stock awards, or you will soon have awards, now can be a great time to explore how much exposure you should have to one company stock, and that can help you determine how much you might want to sell off in any given year. And that answer might depend on how reliant your plan is on your company stock price and its performance. I've seen many clients over the years set a limit of 5% of their overall portfolio as a strategy to reduce concentration risk. I've seen some clients who exercise their awards and get that money into their bank account, or they use it to fund strategies that could qualify for tax-free withdrawals, like backdoor Roth IRA contributions, or tax advantage 529 plans. And I've seen other clients who accept a higher level of risk over 5%. And I've commonly seen that a little bit more often when a client's plan probability of success is at the higher range, closer to 100%. So what makes sense for you is going to be unique to your situation, your plan, your tax strategy, and your tolerance for taking risk. All right, so to recap, number 4 is how can you maximize your stock award strategy? How could you do that? What is your strategy? What's your tax strategy? How much exposure do you want to one company stock? And lastly, question number 5 is what insurance benefits do you actually need? If you're signing up with a new employer, you might have lost some coverage, medical insurance, disability, life, long-term care, maybe other optional benefits that you elected with your prior employer. And a mistake I see too many people make is they wait until enrollment day and they try to contact me very last minute to make some decisions. And sometimes I don't feel confident in those decisions because we didn't have time to run an analysis. So I typically would suggest and urge you to run an insurance analysis before you're making those decisions on enrollment day. And these are just my beliefs. I'm very biased. My opinion is you should work with a fee-only financial planner who doesn't get paid if you buy more insurance, who doesn't receive a referral fee from an insurance agent, because I believe those are conflicts of interest that can result in you buying more insurance than you actually need. I'm not saying insurance agents are bad, but if you buy more insurance than you need and you don't die prematurely and you don't get disabled prematurely or you don't need long-term care, you're essentially giving the insurance company and likely the agent more money in the long run. So I would recommend doing an analysis. Of course, you need a financial plan to do an analysis and figure out what do you actually need or want, and then you can go shop out the coverage, ideally with the independent broker or with your current insurance agent, and compare that to the options through your employer. So that is question number 5. What insurance benefits do you actually need? And that way you'll be empowered going into open enrollment. There might be another question that you want answered, something that's keeping you up at night, and I'd encourage you to answer that. And I do hope today was helpful. If you're faced with an employer change, I hope it equipped you with some questions that you can ask to gain more confidence and clarity about your upcoming financial decisions, whether it's with your benefits, your stock awards, or your insurance. If you don't have a financial plan or you need help answering these 5 questions, feel free to click the link on the screen to get started and request an initial consult. As always, thanks in advance for liking and subscribing. We'll see you soon.